Hey, good afternoon, everyone.
Good afternoon, Professor.
Hello.
Hey, hello, how are you? How are
Good
you
afternoon,
guys?
Professor.
Good afternoon, good afternoon. All righty, so I see nine people. Actually, it must be eight except myself. And then um, let me check in the discussion board. And let's see how many people are there. And I have more people here, at least 11 people here. So please, if you are okay, I see still eight, so I still need three more people to join us. Okay, one person joining. um, okay, Tim is joining. All right, so I hope I'm sure there more people are gonna join the session, join the collaborate um, shortly. And so let's go to okay, where we left off. Yesterday, we were talking about the types of risks. I mean, they are actually sources of the risk. Why risk is why risk was the issue? Because actually the cost of capital, once again, K stands for cost of capital. Cost of capital is just another name for interest rate, but it's more broader concept because interest is only the return on the debt, return on the lending, right? Um, but cost of capital is broader because it can it can be also stock. I mean, not just the bond. Bond is basically borrowing from the company's perspective, and from the investor's perspective, lender's perspective, it's lending. It's a loan. Bond is a loan. Um, so in case of debt, bond is also called a debt instrument, literally because it's debt. Um, cost so cost of capital doesn't mean only bond. It can be stocks, right? But in our context, cost of capital we are talking about is specifically cost of debt. So in other words, I have to use so uh, cost of capital in general, it breaks down into a cost of equity and cost of debt. Cost of equity is return on equity, right? Stock. Cost of debt is uh, uh, the return on the debt. So like interest rate. But it's not only the interest rate. Think about it. There's also capital gains. There can be capital gains and capital loss. So the whole concept of um, the whole concept of cost of debt is yield. Okay, and what is yield? It's another name for rate of return. It's actually of course annualized because all returns must be expressed as annual. Okay, so we are talking about like bond deal, right? So yield. So cost of debt is not only the interest rate because interest is coupon interest, right? Coupon interest is only one uh, source of cash flow. The other source of cash flow is the capital gains. You all remember, uh, basically, if we go back to We go back to the first thing you learned, right? Uh, this is capital gain, right? This is PT and PT plus N minus PT, that's capital gain. And this is the coupon interest, right? So if you annualize it, that's called yield, right? If you annualize it. So cost of capital, because we were talking about cost of capital, we had to discuss what consists or what makes up cost of capital, or cost of debt, specifically in our context. And so it's made of where should I write? So it's made of, right, base interest rate, right, which is pure return plus inflation, right? Okay, this is right. Pure return is real interest rate, and then there's default risk premium, right? Premium is basically what it's a compensation for taking the default risk, and then liquidity risk, and then maturity risk, right? And I already explained this. Maturity, the longer the maturity, obviously there is uncertainty. The longer the maturity, there's more uncertainty than short-term maturity. I mean, we can forecast pretty much with accuracy, with relatively decent accuracy. We can predict what's going to happen within 1 year, right? I'm not saying it's 100% accuracy, but we have, in predicting what's going to happen within 1 year, we can predict better. We can predict with more accuracy than predicting something that's going to happen in 5 years or in 10 years, right? So, especially how the economy is going to behave is we cannot tell whether there's going to be an inflation in 5 years or 10 years. With accuracy, we can. But, with relatively better accuracy, more accuracy, we can tell whether we're going to have inflation or we're going to go into recession within the next 6 to 12 months, right? So the longer the maturity, the more uncertainty surrounding our bond. And then default risk, once again, this is, borrower specific, right? This is not coming from the system. It's not systemic. Default risk is not systemic. It's because it's borrower specific, right? Borrower specific. However, inflation is systemic, right? It comes from the macroeconomic system, so it's systemic. Liquidity is it's also borrower specific. Depending on how good that borrower, how solid, how well known, or how credit-worthy that borrower is, liquidity risk can go up or go down. So what is liquidity? First of all, we have to define what is liquidity. And I believe I roughly defined it in passing. It can be defined on 3 levels. What is liquidity? On the first level, it means how easily you can convert any any asset into cash. So if you think about it, then cash is the most liquid asset because nothing, cash is already cash. Nothing beats cash in liquidity. And liquidity means how easily you can that asset can change hands, right? Cash, everybody will accept cash. There's no one that won't accept cash. As a means of payment, right? Uh, Stocks and bonds, um, can they easily change hands? Uh, yes, not as easily as cash, but think about it. You can easily sell stocks and bonds in the market and convert it into cash, right? And even if you don't sell it, you can use it as sometimes you can use it as a medium of exchange. In other words, um, suppose uh, you're buying pizza, and of course, pizza, it won't be that much. I mean, $20 you can buy for $20 you can buy 18-inch large pizza. But no one pays for $20 pizza with Apple stock. I mean, if you have Amazon stock or Apple stock, Amazon, let's say, or Google stock, it would be about, how much is it today? Yesterday they fell to, but it would be 100 and something, 100 and.
What about margin? I used margin a lot when I had stocks. I would just
What,
stick with that.
what margin are you talking about?
Like when I sell my stock, it would be valued at less than $20,000. So they would just open a margin loan, give me the money instantly, and wait for the stock to settle. So that would be instant cash. I would just go to
Uh,
that.
so the margin you're talking about is the margin in margin trading?
No, I didn't trade it. I literally just took it out as cash and bought whatever I wanted with it. It was literally created as a margin loan, and it would charge me like 0.1% interest, but it wouldn't never get charged interest. It would just be
Okay,
there.
so first of
It's
all,
like Coinbase?
No,
No?
I use that.
the
Or
okay, first of all, margin, we have to margin is usually, when you borrow money to a margin. If you have a margin account, that means you're trading stocks with borrowed money, right? If you're talking about that margin, I'm not sure how it is related to what I'm talking about right now, because um, if you're buying stocks on margin, that means let's say your own money is let's say $10,000, and you borrowed $90,000, and that $90,000 is margin, right? And then um, so that means the total amount of money or your position is $100,000. And with $100,000, if you buy, you can buy more stocks, of course. But then think about it. Your stocks went up by 10%. Then uh, if you had only $10,000, if you
uh,
had only
question.
$10,000,
I didn't get like
The
that.
margin is they charge interest when they borrow money to you, right?
of course, it's not for free. As I said, if you are trading on a margin account, I told you, you're using borrowed money to trade stocks. They won't do it for free. They will charge interest, right? It goes without saying. So, and the only reason you are doing that is because you are using a leverage, but then you're leveraging I mean, if you had only $10,000, with $10,000, let's say you could buy only 10 shares, right? But with $100,000, you could buy 100 shares. Regardless, and if it went up by 10%, so this is just getting digressing. So and then it's getting if it is digressing, then it takes too much time to come back to what I'm talking about. So let me get back to that first. So I was talking about if you bought, let's say, okay, Google is 113 today, and Amazon is better, and the reason I was talking about that, see, I lost track of my thought, right? I lost train of my thought. I was talking about the liquidity. So yeah. Oh, okay. So it was this. So nobody pays for pizza with Apple or with Apple share, or nobody pays. Let's say Google is $100. You can, of course, you can pay for a pizza with one share of Google stock if they accept it. And pizza shop owner will accept it, knowing. I mean, if he knows that the Google is $113 today, and if Google went down, but it's going back up, so the pizza shop owner thinks that the Google will be $120 tomorrow. Yeah, he will accept it. But of course, then at today's price, 113, and the pizza is $20, so he will give you change for 113 minus 20, right? Still, what that means, but in reality, nobody pays for pizza with Apple stock or Google stock. But if it comes to that, it's doable, and that means it's liquid asset, meaning stock is liquid. It can easily turn into cash, right? You can sell it and turn it into cash. And then, of course, Bitcoin. Bitcoin has been around since like 2009, and in the early days, someone bought pizza. Someone paid for pizza with Bitcoin, because in those days, Bitcoin was, he had to pay like how many Bitcoins to, I mean, three Bitcoins or 5 Bitcoins to pay for a pizza. But of course, nowadays, nobody will pay for pizza with a Bitcoin, right? First of all, the pizza shop owner must have a sort of what do they call it, a digital wallet, or the wallet to because it's not really physical coin. Two, Bitcoin, I think, is I haven't checked, but still around $30,000. I mean, if it is $30,000, who's going to pay $30,000 to buy a pizza? That's just out of that's just ridiculous, out of question. So is Bitcoin then liquid? Of course, it's liquid asset. It's liquid because you can easily turn that into cash. So first level of definition of liquidity is how easily you can convert the asset into cash. Second definition, it means cash flow. Yeah, think about it. If a company has a lot of liquid assets, that means the company won't have to worry about running out of cash flow, because if they are holding a lot of liquid assets like stocks, bonds, they can always, and when they can always turn it into cash. They can always sell it and turn it into cash. And why do they have to turn it into cash? Because they have payments to make, short-term liabilities, payments to make. A company with a company with high liquidity, that means company has uh, high cash flow. Um, Third level, on macroeconomic level, that means money supply throughout the economy, liquidity, if the economy uh, has plenty of liquidity, that means there's a lot of money supply. And if when they say the liquidity dried up, that means there's no money supply. I mean, little money supply, and it's because banks are not lending, right? It's called credit crunch. Banks are not lending, and usually when there's a financial crisis, banks hunker down and don't lend because they have to first they have to save themselves. They have to save their own ass first. So if they cannot lend out, they have to. If there's an outstanding loan, they will try to collect them first, right? So that's the definition of liquidity. And then what is the liquidity risk then? It's literally the risk of not being able to converting that asset into cash. And what kind of company has liquidity? If the company is not well known, if the company is relatively new and not well known, their liquidity, they have high liquidity risk. So and the fourth one is a liquidity. The fourth one is maturity risk, and the maturity risk I already talked about it. And because of the maturity risk, we see something called yield curve. So what is yield curve? So this is not moving now. Ah, yeah. This thing is not moving. Okay, this thing is not moving. So let's see. I can maybe refresh and. All right. Yeah. Okay. Now, because of the maturity risk, we see some called yield curve. And what's a yield? And we already know what yield is. Yield, I told you, yield is annualized return. Annualized return. And then the bonds have different maturities. There are short-term bonds and long-term bonds. And the maturities are basically, as short as 1 month, right? For short-term bonds, there's 1 month bond, 3 months bond, 3 months. If it is bond, it's not called. If it is short-term, it's not really the name. Official name is not bond. Like 3 months note or commercial paper, promissory notes. If it is corporate bond, if it is treasury, it's called bill. 3 months bill, 1 month bill, 6 months bill, 1 year. And then after that, 1 year, 2 years, 5 years, 10 years, 15, 20, 30 years. Those are the maturities. But of course, when the bonds were issued, they are born as, let's say, 30-year bond. Okay? They are born as 20-year bond, or they are born as 15-year bond. They are born as 10-year note, 5-year note, 2-year notes. But as time goes on, think about it. 1 year later, 30-year bond has only 29 years left, right? And another year later, that 30-year bond has 28 years left. So although they were not born as 29-year bond or 28-year bond, but as the time goes on, the bond will have maturities from 1 month to all the way to 29, 30 years, right? And the longer the maturity, the more the uncertainty, the more the uncertainty. So the yield will have to be higher. In other words, the return has to be higher. And you might wonder, Oh yeah, if it is a 30-year bond, then obviously the return should be higher than 1 year because you're holding it for 30 years. Obviously, when I say yield, I told you, yield is annualized return. So obviously 30-year holding period return, I mean the return over 30-year holding period should be greater than 1 year return, goes without saying. But that way you cannot compare these two securities. One one has just 1 year maturity, the other one has 30-year maturity. Then you cannot directly compare them. That's why we have to annualize, right? Remember? So when I'm saying yield is increasing with the maturity, that's annualized return. In other words, annual return for longer term bonds have to be greater than shorter term bonds, right? Of course, and it's obvious because longer term bonds have more risk, right? Maturity risk, right? To compensate for that higher risk, you have to pay a higher return. So normally the yield curve will look like this. It's an upsloping curve, upsloping, right? So this is a 13-week or 3 months or 90-day note, or commercial paper or promissory note. But then as time goes, as the maturity goes on, 30-year maturity bond will have to higher. But then sometimes you see inverted yield curve, inverted. And that means, short-term bond yields are higher than long-term bond yield. And how is that possible? How is that possible first? But it is possible, and it happens. It happens when when there's an impending or imminent recession. In other words, when the market is anticipating recession in the short run, and as I said, short run means within 1 year. If the market is anticipating a recession within 1 year, you will see inverted yield curve. Now, let me show you. Actually, so I looked up Treasury yield curve as of June 28th today, right? Look at this. This is, you can see this is normal yield curve. 1 month yield is 1.12%, 2 month, okay? So the longer the maturity, you have higher higher yield. And you might, okay, then 20-year has higher yield than 30-year. So does that mean inverted? No, this doesn't mean inverted. This is generally the pattern is correct. It's normal. But then if something like 3 month, 1 month, 3 month bond yield has higher return than 30-year or 20-year, so that the curve looks like this, then that's inverted, right? That's inverted yield curve. And again, also sometimes they show yield curve this way. This is you see what is saying 10-year Treasury minus 2-year Treasury. Okay, 10-year is long-term bond. 2 years is still long-term. I mean, anything. So this is not really meaningful because 2 years is still long-term. So this is the yield differential. In other words, yield differential. That means 10-year yield minus 2-year yield. Normally, it should be positive. Isn't it right? It should be positive. Isn't it right? Because 10-year yield will have to be greater than 2-year yield. Isn't it right? So under the normal circumstances, under the normal economy, this number should be positive. But if the recession is anticipated, it will be negative. 2-year bond yield should be greater than 10-year bond. But of course, 2-year is not short term. It's relatively shorter term than 10 years. Usually, if it is the case, then you should use like 3 months. And if 10-year, the difference between 10-year yield and 3 months yield is negative, then that's the evidence of inverted yield curve. Isn't that right? Think about it. And this is, see, as long as they are positive, below this is negative. And back in 2019, like August 27th, it was slightly below zero. But again, this is not really the signal of recession, because once again, it's a 10-year minus 2-year. If this was 10-year minus 3 months or 1 month, and if it was significantly negative, this is just slightly negative. If it is so now 2000, here we have July 20th this year, 22. 10-year and 2-year difference is negative 0.2. Negative 0.2%. Again, this could be a strong signal for recession if this is 10-year minus 2 years, 10-year minus 3 months. But this is 10-year minus 2 years. So this is not really a strong signal. But if you see, if this was 10-year minus 3 years, and if you see the difference in the negative range, it's a clear signal of impending recession. Okay. Another one, Treasury yield curve, yes, like 20-year, 30-year. Hey, come on. So here's the interesting part. So why is inverted yield curve the sign of impending recession? Why? Of course, anybody who studied economics, with economics background, they can tell. They know inverted yield curve is the signal of impending recession. But that's just the result. It's just the end result. It's just the end result. In other words, you should be able to explain the cause. What caused inverted yield curve? And you can tell.
You asking us?
Yeah.
Because it inverted because the demand for longer term bonds increased, which lowered the yield for longer term bonds and increased the yield for shorter term bonds.
Yeah. You said, basically, you summed it up. The full logical process. Full logical process is missing yet, because of course, to explain the full logical process, it takes more time. You cannot just put it into one sentence. You have to put it into a paragraph. So understandably, okay. So who was that? DeAndre, right?
Yes.
Okay, DeAndre. So I'm gonna give you 1 point. This one is fnb100, and today is 0728. Yes. Now I explained it in my video, but to recap it, yeah. First of all, if recession is anticipated and within short term, within 1 year, and of course, as I said, forecast is only reliable relatively, within short run because, I mean, how reliable is a recession forecast beyond 5 years? I mean, even beyond 2 years, we don't know. It's the forecasting reliability of the forecast over 5 year horizon, 10-year horizon is not. But it doesn't really affect you. It doesn't really affect the market, right? 10-year forecast, 10 years later, there's going to be a recession. It doesn't affect the market right now. But in 6 months, there's going to be a recession. It affects the market. Or if if there's going to be a recession in 6 months, what do? I'm gonna pull out from the market. Don't you think? I'm gonna pull out from the market. I mean, if my money, especially if my investment is in the short-term bond, like the short-term bond that will mature within 1 year. So some of those will mature within 6 months, or within 7 months, 8 months, or within 1 year. But if the recession hits in 6 months or in 8 months, I cannot be sure about the safety of my money. I mean, the company that borrowed money from me, suppose I have 1,000 bonds of company X. And I remember 1,000, each bond has a face value of 1,000 and it matures in 6 months. So that means $1 million, right? 1,000 times 1,000, $1 million. So my bond matures in 6 months. The company will have to pay me $1 million. And that's the time exactly when the recession hits. And in recession, what happens? Liquidity shortage. I mean, credit crunch. I told liquidity dries up. Why? Because it's recession. Banks hunker down. You're not making a lending. Why? In recession, why would you make a lending? You cannot lend lavishly because the prospect or the outlook of any business is dismal, right? During the recession, hardly any business is doing well. There are some businesses that still do well during the recession, but in general, most businesses will. That's why it is recession. So they are not going to expand lending. They're going to actually recall their money. So the company that has to pay me $1 million, they will have hard time. They will have hard time coughing up $1 million, right? Makes sense. They may default. In other words, at least the probability of default will increase. Isn't that right? During the recession, under recession, the probability of this borrower defaulting will increase. So I'm going to pull out my money. I'm going to sell my short-term bonds and pull back my money. And then what do? I would rather keep my money. I mean, but if I pull back my money and just hold it hold it as cash, holding cash means what? Cash doesn't earn anything, right? Cash doesn't earn anything, isn't that right? Holding cash means actually keeping it in just your checking account, isn't that right? Holding cash sounds like holding cash in your hands, but actually $1 million, nobody holds that $1 million in their hands. They keep it in the checking account. And when you keep it in the checking account, it doesn't earn anything. So what do? Even though it's going to be a recession in 6 months, you pulled out money from short-term bonds, but then you put that money into long-term bonds, like 10-year bond. Why? First of all, the company that sold 10-year bonds to you, their maturity won't be in 6 months. Their maturity will be in 10 years. So they won't be hit hard. I mean, they don't have to cough up $1 million in 6 months, right? They won't have to cough up $1 million in 1 year. They will. It will be 10 years later. So they can weather out. They can weather the storm. They can weather this recession. So because they don't have to cough up $1 million when recession hits, all they need to do is just pay interest throughout the recession, and they can do that. I mean, they have a better chance of doing that, right, than the company who has to cough up $1 million or $10 million in the middle of the recession. Right? Makes sense? So that way, demand. Then think about it. The demand for long. This is the logical process. This is the logical thinking. So I really want an analytical thinking. So I really want you to catch up with this. So if you buy long-term, if you pull out from the short-term bond, what's going to happen to the price of the short-term bond? Price of the short-term bond will fall, right? And you put that money into the long-term bond, what's going to happen to the price of the long-term bond? It's going to go up, right? Then why, if the price of the short-term bond goes down, why does the yield or the return on the short-term bond goes up, right? Yield curve, inverted yield curve means short-term yield is greater than long-term yield, right? So how does that happen? I mean, price of the short-term bond goes down, then how does that cause the short-term return to go up? And how does, when the price of the long-term bond goes up, how does make the return on the long-term bond go down? You remember, yeah, anyone? Yeah, go ahead. Someone was trying to say something. No? Okay. So the thing is, you already saw that the inverse relationship between the price and return, right? Inverse relationship between the price and return. Or the inverse relationship between the price and the price of the bond and the now back here. This is, remember, this is, why U.S. Treasury, return on the U.S. Treasury is called risk-free return. Basically, why? The face value, another name, maturity value, par value, redemption value. Remember? Face value of all the bonds are fixed, $1,000. That's what you get at maturity. Hence, face value, maturity value, redemption value, because that's the price they pay to redeem this bond, right? The Treasury Department is they redeem this bond from you by paying you $1,000, right? So redemption value. Or par value, par. $1,000 is par value of the bond. So it's a fixed number, but then think about it, how does this risk-free return goes up? If the selling price goes down, okay, if the selling price goes down, we talked about this. Where is it? If the selling price goes down, the whole numerator goes up because this goes down. This is a fixed number. Numerator will go up. Denominator goes down. So with a bigger numerator, smaller denominator, the whole fraction will have to go up, right? So exactly that logic. It's exactly that logic. Because think about it. As the price of the short-term bond goes down, the whole numerator goes up. So the whole fraction goes up, right? And also the opposite. This is a fixed value. Price of the long-term bond goes up, so the whole numerator goes down. Denominator goes up, so the whole fraction goes down, right? This is the mathematical logic that cannot be disputed. This is undisputed. Nobody can dispute it. This is law of physics, law of nature, law of math, right? Mathematical. So long-term yield becomes lower than short-term yield, and that brings us to the inverted yield curve. Okay, and that's the explanation. Of course, in reality, nobody will ask you to explain why when there is a recession coming, it will show inverted yield curve. Nobody will ask you to do. But you will only need to know, oh, when there is an inverted yield curve, it's a sign of impending recession. Well, again, okay, what was the Fed FOMC meeting result? I mean, I haven't, I had a class. I mean, I have two classes every week.
They increased it 75 basis points.
It was 75.
Okay, so it's not a big step. It's just 0.75%, like the last time. You see. Thank you for. You see.
They was something that I don't understand is when they say is equal to 2.25 in the last 2 months.
No, last month it was like 1.25. Why? Because before June, the Fed funds rate was at around 0.5, and then in June they raised it by 0.75. So it went up to 1.25.
Altogether right? In the last 2 months, right?
Yeah, in June, and then now they raised it by 0.75. So then it will be like 2%. Isn't that right?
Yeah, 2.5.
2.5? How can it be 2.5? I mean,
no, 2%. Sorry.
2%. I guess it should be 2%, right? Because last month it was 1.25. But again, remember when they say the Fed funds, when Federal Reserve says Fed funds rate is now 2%, that doesn't mean the actual rate is 2%. It's their target rate, and then through the open market operation, right, through the market mechanism, they will try to bring the actual Fed funds market rate close to their target range. So their target is something like the target is not a single number. It's not a point. It is some kind of range. So the range would be somewhere between 2 and 2.5. And they are trying to, through the open market operation, they will be trying to bring it closer to close to that target range. So it will be actual market rate will be somewhere between 2 and 2.25, right?
Yeah,
something
that was my question, because in the announcement they put like 2.5, 2.2 to 2.5.
Oh, so that's still very high. That's still high compared to my expectation, because last month after raising it by 0.25, then mathematically, I mean, just mathematically, it should be like the target range would be 1.25 to 1.5, because before June, it was like target range was somewhere between 0.25 and 0.5, if I'm not mistaken. But anyway, so that means they didn't take a big step. So that means if they not taking the big step means that Fed is also Federal Reserve is also in consensus with the rest of the market that the inflation peaked out. I mean, short-term inflation is almost like 9 point something percent, 9.6% or something. But they buy this consensus that the 5-year average long term is something like 2.75. So long-term inflation, and gas prices falling, and the supply chain disruption, supply chain bottleneck is easing up. So with all that, so they didn't take big steps, and no wonder, because if they raised it by 2%, if they raised it by 1% or more, I wouldn't see all these green. And I had a class. I have 2 classes every day, from 3 to 5:15, and 6 to 8:15. So I wasn't able to watch the news, but from all these greens, I could tell. Oh, obviously, the Federal Reserve probably they said increase by 0.75. Yeah. Okay, so that explained, inverted yield curve. Now, so I just I was, someone was asking about margin, earlier, and because I had to wrap up this, I cannot just, stray away from the main. So I want to quickly revisit that issue. So someone was asking, margin, right? And again, I want to make sure that if that student meant margin in the same sense as I was, in the same sense as I was saying, because margin trading, margin is basically margin trading, margin in margin trading, or margin account, and margin account is like leveraged account. In other words, if you have only $10,000, you should trade stocks. I mean, you should trade stocks within your means. I mean, with only $10,000. But sometimes, your broker, if you have, your broker will lure you. They will sweet talk. They say, well, suppose you, with $10,000, you made, let's say 20% return. You bought, Google when it was $100. I mean, Google was never at $100, but let's say Google was $100. And you bought, with $10,000, if Google is $100, you can buy 100 shares, right? And then within a week, let's say Google went up from 100 to 120, then you make 20% return, right? Then some guile-mouthed, or guile-tongued, or I almost these guys, the broker from the brokerage, they will say, oh, you are born with it. You are born, you are natural. You are natural in this. You are born with it. You make 20% return just in 1 week. So you must be born with it. You are natural in stock. And then, so you get, flattered, of course. And then they will say, oh, too bad. I mean, if it was only $100,000, you could have made, $20,000. I mean, you could have made, $20,000. But because you had only $10,000, you made only $2,000. Wow. So then you think, oh yeah, if only I had, I could have made, 20,000, not just 12. Then he says, he offers, well, we can lend you some money. Look, if only you lended, you could have, if only you knew me before, and we could have loaned you $90,000, then your total position is 100,000. You could have made um, 20,000. Of course, still that's 20%. I mean, in return, it's still 20%. But then think about it. After making that, you pay them back 90,000, and they will ask for but we're lending you money, so it's 10% interest. 10% of 90,000 is 9,000. So after paying back 99,000, you still have, right? Think about it. 120,000 minus 99,000. So you still have made more than 1,000, $11,000 or something like that, right? So obviously, yeah. Then you buy that proposition. So you take margin. The problem is, if you win, I mean, if the market goes up, if market continues to go up, your stock continues to go up, it's a win-win strategy. You win, they win. But if your stock goes down, it's not win-win. You lose, they win. They still win because they loaned you money, you borrowed the money, you have to pay them the principal and interest, right? And when you use a margin account, when you have to maintain like minimum margin, and if minimum required level, minimum required balance, if it goes below that, there's you get the margin call, and if you get the margin call, it's going to be your hell. They are not nice people. In other words, they're not going to think about it. It's money. Suppose you have $1 million margin account. Do you think you're going to let you go free, or just talk nicely to you? Margin call is going to kill you, really. They're going to harvest your organ to get right. They are really cold-blooded. The people who try to hook you into margin account, they are cold-blooded. Really, they are really cold-blooded killers. Okay, don't even so margin. I mean, if that's the margin that you're talking about, I mean, this is the margin that I know. Okay, if you're talking about the margin, that the same thing. Yeah, that's all I can tell you. I don't know if that's the margin that you are talking about, right? Is that the same thing? I mean, there was someone who was talking about the margin account. Is that the same?
Clear. For me, it's clear.
Okay. Alrighty. So that wraps up everything. That wraps up everything about the ROI. The first topic is done. So I think this is a right time to take a 10-minute break. So let's take a 10-minute break. And when we come back, we're going to move on to the second topic. And the second topic is, I think it's here. Oh, is it? Yeah. And course, if you go to the course, financial statements, right? Fundamental analysis, financial statements. Right. We're going to move on to the second topic. Okay. All righty. So let's take a 10-minute break. All right, we're back. We're back. Okay, so the second topic, financial statements. This is basically, remember topic one was how we look at the return on investment from macroeconomic perspective, right? Because we started out, I told you in topic one that all return on investments are basically uh, built up on um, the interest rate, because the interest rate is the baseline of all return on investments. Nothing can be um, no return, because all return on investment involves basically uh, some level of risk, I mean, varying degrees of risk. However, interest rate is zero risk, basically, right? Interest rate has, uh, so all investments that involve risk must pay higher return than the interest rate. Otherwise, there's no reason to put your money into risky assets. You'll simply, put your money in the in the bank and earn safe interest. Um, that is, better than the return on the stock, right? If any stock, uh, there's no premium for risk. Um, so that's why it is macroeconomic perspective, right? Because what is the lowest baseline return on investment, baseline return on the money, interest rate, and then all the rates stack up on that baseline. Now, but if you are looking at it from the company's perspective, I mean, if you're looking at the return from the company's perspective, from so it's a micro view. Companies, for companies, return, they don't look that far. I mean, they don't. They can compare it to the average return on investment throughout the economy, but primarily they will look at their profit, right? Um, to calculate some return measures, they will first look at their profit. So it's a micro view. So I believe I have, okay, did I open this? Did I download? I sure, I gotta download this first. Financial statements. Let me see if I had it already downloaded. Maybe not. Okay, it's there, so I can use this. But then I must, okay, to open it, I have to have it in my cloud account, my OneDrive. Let's see. Now, I believe I explained to, what is this? That's business method. I'm gonna put it. So you see, I sent out a new announcement today. I wonder if you've seen this. How to claim your Office 365 account to use Excel. I mean, if you have Windows computer, if your computer is basically running on Windows, you have no problem. And of course, if you have Excel installed on it, you have no problem. But if you don't have Excel installed on your computer, you can download it from um, Office 365, which is basically on access. As CUNY students, you are given this access, so you can download Microsoft Office softwares. And if you have Chromebook, right? If you have a Chromebook, not running on Windows, but Chrome, um, Excel, you cannot download Excel. I mean, even if you download Excel, it doesn't work. If you use Chromebook, the Chromebook wants you to use, Google Sheet. I think, the reason the Chromebook is cheaper than Windows computers is because they're not paying, they don't use, Windows. And if it's run on Windows, um, all those, royalty, or you have to. But then on Chromebook, you cannot really fully deploy Excel. I mean, Excel cannot be used as conveniently as it is used on Windows computer. But then you can still claim your account on Microsoft Office 365, and they will give you, and through, you can use Excel, web-based, right? Web-based Excel. They give you also the what is that called? OneDrive account. So you have your cloud. So basically, let me see if I have it here. Financial. I'm sure I have it. Sorted by type. Okay. Okay, not here, but at least here. Financial statement. Oh, where is it? Oh, here. No, that's homework. Oh. So I think I will have to upload it. A fundamental analysis could be here. All right. No. Okay. Bear with me. Okay. So it's uploading. So it's done. Okay. Just one. Okay. It's taking so much time. Okay, it's taking so much time, so let me just start with the whiteboard. Okay, it's opening. So I need only one copy, so I'll just close the other. All right, so I will let it, and this whiteboard isn't opening either. Okay, now. So when we say financial statements, right, actually they refer to four different statements. Okay, delete. Okay, so I'll have to give it, whether I like it or not, I'll have to give it a few minutes. Okay, now I have. All right. And let's see. Whiteboard. All right, the whiteboard is also frozen, so it's still loading. So let me just talk about it verbally. So financial statements refer to four types of statements. One is income statement, most of all, income statement, and then balance sheet, a cash flow statement, and that's the third one, cash flow. Number four, retained earnings statement. Okay. And then income, we're going to look into the income statement first, because income statement has pointing to profit or loss. Okay. Quite often, a lot of students misunderstand. They get confused, and they think all financial statements are all about profit. Are about profit. Only income statement is directly about profit. Okay. Balance sheet is not about profit, but balance sheet is about capital structure. Okay. Cash flow analysis is really about cash. Okay. Really about cash balance, because not everything is in cash. Retained earnings statement is about earnings and dividends. Okay. So to understand basically to understand what we need to look first, what we need to look first, we need to go to income statement. Okay. So this is the board is so frozen, so I can't revive it. I mean, until it is automatically until it releases itself. So then, okay. Oh, So the Chrome is, I think it's not, it hasn't crashed. I don't think Chrome has crashed. Yeah, it's there. So okay, it's still there. So whiteboard isn't opening, so I'm going to use something else. Canvas. This is also a little stretch because when the computer is not responding, that means the RAM is fully maxed out. And okay, so so you have to give some breathing room to RAM. But I'm pushing it to the limit. It's almost like running at 100% capacity. Okay, here I like this, and then okay. So, all righty. Financial statements, as I said, four types of financial statements. 1, 2, 3. First of all, okay, it's slow. It's also freezing. Ah, yeah. Now the whiteboard is opening. Okay, income. Why isn't it? Income statement. And then balance sheet. And I'm sure some of you have taken accounting 122, so this is something you have already heard about. But then in accounting, they just tell you what to do this, do that, but they don't give you the reasoning behind it. They don't do much about the reasoning. Why? In other words, they don't explain why. They just tell you do this, do that, but why you should do that or why you should do it this way. Accounting doesn't care about that. On a higher level they do, because for in everything there must be some reasoning. But on a like intro level accounting, they never tell you the reasoning behind it. They just tell you do this, do that. But this class is all about reasoning, analytical reasoning. So we'll talk about why we do it that way and why it is, how it is, done that way, and why. So the third one is cash flow statement. Okay, it's frozen again. Cash flow statement. The fourth one, retained earnings. retained earnings. Okay. Although it would be ideal if we could go over everything, but the cash flow statement and retained earnings statement, we're not going to talk about those two things in this class, but we're going to later, we'll FNB 300, 230, I'm sorry, FNB 230. Okay, finance 230.
You get caught
More.
for a few minutes. You get caught for a few minutes.
Hello, are you talking to me?
Yeah, you get caught for a few minutes.
Okay, so we're going to be looking into a mainly balance. I got a what? I think okay. I don't think you were talking to me. So we're going to be looking into income statement and balance sheet. Okay. And since this is freezing, this keeps freezing, I'm going to close that and go back to if. The whiteboard is still giving me a hard time. So now first, let's think about the income statement. Now, when we say income, right? In the income statement, okay. When income, actually, in accounting, they use the term income in a very confusing way because it's not consistent. The way in accounting they use the term income is not consistent. Or I mean, you can call it revenue. It's not logical. But the income statement, the full name, its income statement is actually short because the full name is income and expenses statement. Income and expenses. Expenses. But we know if you subtract expenses from income, that's called, what is it called? Anyone? If you subtract
Profit.
expenses from income, what is that called?
Net profit.
Net profit. Yeah.
Profit, yes. And yes, who said that? Who said profit?
We both
No,
said that.
not net profit yet. You just subtracted expenses from. Hmm? So who said profit? I mean, it's generally, yeah, you can
I
call it
said
profit.
Ifat.
Hmm?
Ifat.
What? Ifat?
Yes. Yes, profit.
Okay. Ifat, you said profit, right? Okay.
Yes,
Good. I'm
someone
going to
else
give you
also said that,
0.5 for
Professor.
that. Yeah. Yeah. So who was that? Who else said profit?
It was me as well, Professor DeAndre.
And that's who? DeAndre?
Yeah.
Who was? Who? There's a lot of
Yeah, DeAndre, you're right.
Okay, DeAndre, because there's a lot of gap in the. I don't know if it is. Most likely, it could be my computer because my computer is running out of resources. I can tell my computer is running out of resources because having such a hard time opening anything. So I will have to. Yeah, now it opened, but I wonder.
Professor, does it help if you restart your computer?
yeah, maybe if I restart my computer, it will help. But then, you will have to excuse me for like probably 5 minutes, right? I have to restart everything. So,
Yeah, we can do it maybe if everyone is agree.
okay, I can restart my computer, but everyone is okay if I am excused for about 5 minutes, because when I restart, obviously you will lose me for about 5 minutes until I restart everything.
Yeah, we okay.
Right?
I'm okay.
Okay. All right. Thank you. So then I will restart the computer. And so I'll try first of all. Okay. Uh, Come on. I can't even get the restart. Completely fried. What is this? All right, I'm back. But let's see. I will have to set up everything all over again. So, good thing it is still being recorded. Um, okay, share my screen. All right, so you guys can hear me, right?
Yes.
Okay, good. All righty, good. Thank you for confirming that. Um, so, um, yeah, that's there. And then, where is the? Okay, fine. I wasn't using anyway the PDF file, so that's fine. Okay, so okay, whiteboard now, whiteboard. So we're talking about income statement and balance sheet, but I'm gonna come back to balance sheet later. But I said income statement is originally income and expenses statement. Income and expenses statement. That means income and expenses are two major pillars of the income statement, of course. And so one big pillar is income, and the other one is expenses, right? Of course, you subtract expenses from income, then that's called just generally profit. But the correct term is operating profit or operating income. The correct term, if you subtract expenses from income, is called operating profit or operating income. Now, the symbol pi, I told you, symbol pi, the pi is a symbol for profit in microeconomics, although it is a symbol for inflation in macro, right? Now, but more technical name for operating income or operating profit is EBIT. Anybody ever heard of EBIT? Anyone?
Yeah, it's earning before income and taxes.
Earning before, not okay. Earning before, not income, interest. Earning before
Oh,
interest,
sorry. See, I'm
interest
rushing.
and tax. Yeah, earnings before interest and taxes. Now, another thing. First of all, income means what? Income is basically income means revenue, right? Income means revenue. I mean, there are two sources of income. The first one is revenue. Revenue means sales revenue. You have to sell something, right? All businesses must sell something to generate revenue, right? So, in one source of, or the primary source of income is revenue. The secondary source of income is what they generally call passive income. But what is passive income? Passive income is something like investment income or rental income, right? In other words, revenue is generated through your operating activity. Operating activity, right? Operating activity is what? You hire workers and resources and capital and produce something and sell something, and you receive income, or you receive, you generate revenue. That's revenue. In other words, that's not passive. You actively engaged in operating activity. Okay, so revenue is the result of the operating activity. Passive income, it's not the result of operating activity. It's suppose you have the company is holding like $1 million, $10 million in company X bond, and there is annually interest is 10%, interest rate is 10%, then that's 10% of 10 million, so 1 million is the interest. So it's passive income. You didn't engage in operating activity to earn that income. If it is dividend from the stock, that's the same. I mean, you are holding, like, $10 million in Tesla. Tesla is currently about what, 600 something, 800. Let's say Tesla is 600. Then with $10 million, how many shares? Of course, you can divide 10 million by 600. But each share, let's say, paid $1 dividend. $1 dividend. That's too small for a like a $600 stock. But let's say so they paid $5 dividend a year. And then you may be holding probably 20, if it is 10 million, something like 20,000 shares. Dividend would be then 20,000 shares times 5, so $100,000, something like that. So that's all passive income, right? And then the term income, I'm not very happy about the term income being used in accounting, because in accounting they also they call this both operating profit or operating income. They also call this income. So then this gets very confusing. Why? First, then income is gross state, gross. In other words, before netting out, before subtracting expenses, that's called income. But even after subtracting expenses, if they still call it income, it's very conflicting. I mean, after subtracting expenses, you're back here, and then you're back here. So that's ridiculous. Once you subtract expenses, I think it stands to reason. It's only rational to call it profit or earnings. So you can tell from here that earnings is just another name for profit. But continuing to call it income, that I can't agree with that. But there's a reason. Later I will tell you. I mean, if this is company, calling it income still doesn't make sense. But if it is an individual, then you cannot call that profit. I mean, so I'm gonna come back to that later. But here, so we have two sources of income. Also, we have two sources of expenses. So primary source of income is revenue. Secondary source of income is passive income, like interest income or investment income in general, investment income or rental income, royalty. I mean, if the company has copyrights, the royalty, things like that, or patent, right? The royalty on patent. Now, expenses. In general, expenses means cost, right? Expenses mean cost, but there are two types of cost. Primary source of cost is direct cost. Direct cost and indirect cost. Direct cost and indirect cost. Of course, direct cost is the primary source of cost or expenses. So in microeconomics, direct cost is called variable cost, variable in microeconomics. Now, direct means it's directly related to production activity. hence called direct cost, because it's directly related to production activity. And indirect cost is so called because it's not directly related to production activity, right? So now if so I'm gonna have to go to the next page. So I'm gonna have to delete this. So everyone is good with this. I can erase this, right? Okay. So I'm gonna delete that. First of all, then let's think about revenue. Which is the primary source of income. And revenue is basically the payment you receive for selling something. So revenue can, but defining revenue verbally, I don't like verbal definition because verbal definition is fuzzy and is cloudy. It changes every time. If I, uh, uh, it's like the telephone game. You may remember or understand what telephone game is. You line up people in a single file, so you like 10 people in a single file. You pass on a message, whisper the message to the first person so that the other people cannot hear. The first person then relates it to the second person also, in the ear only, so whisper. And you pass on the message from the first person to the last person, and by the time it reaches the last person, then the message completely transforms to something else. Why? Because everyone adds something to it. They add their own interpretation. It's open to interpretation. So it gets paraphrased and rephrased and over and over again, and then it completely turns into some monster, something else. So I don't like verbal definition because it can change. It's not infallible. So the best thing is always the mathematical definition. The mathematical definition of revenue. Anyone knows what's the mathematical definition of revenue? Hmm? What is the mathematical definition of revenue? Anyone?
Is it just the quantity times the price?
Yes, yes, exactly. It's price times quantity sold. Price times quantity sold. And who was this?
Mei Chen.
Actually, isn't it Mei-kin? I mean,
But
phonetically, I was trying to look up Mei-chen, and there was no Mei-chen, but there was Mei-kin.
yeah,
I don't know if it is actually in Chinese, maybe it's pronounced Mei-chen, but phonetically, the way I see it, it looks like Mei-kin. Isn't it right?
yeah, a lot of people pronounce it that way too. Yeah.
I mean, that's what, it's Q, isn't it right? I mean, is Q, I don't know if it is pronounced as CH in Chinese, but the way I understand it, Q is K, Mei-kin. So, all right, Mei-chen or Mei-kin, I'll give you 1 point for that. Okay, I'll give you 1 point. Yes, it's priced. There's nothing else, That's exactly price times quantity sold. I mean, no other definition can dispute this. This is indisputable. There's no logical flaw here. There's nothing. In other words, you cannot attack this type of, you cannot argue with this type of definition, right? Suppose you are selling, your store is selling, you have a business and a store, and your store is selling, let's say, tennis rackets. Of course, there may be, if you're selling tennis rackets, then, it must be a sporting goods store. There may be other things, but let's say you're selling only tennis rackets, only one model, then it will be very simple. If you sold, and the price of the tennis racket is on $50, let's say, and if you sold 10, right, it will be 500. Isn't that right? If you sold 100, 5,000 or 5K. And if you sold 1, just 50. If you sold 0, 0. Right? What else can it be? How straightforward and indisputable, right? So revenue is price times quantity. And then think about it. If because this is a sporting goods store, you have other products, not just other items, not just, but even for tennis rackets, I mean, you have different models by different manufacturers. So then, if you sold, let's call tennis racket X, right? And if you have if you're carrying 5 models of tennis rackets, all you need to do is, how many X1 did you sell? Then price of X, let's say X1 times quantity of X1 sold, plus price of X2 times quantity of X2, right? This way, I mean, all the way to X5, right? If you have 5 models. And you know better than this, because we can, so the revenue from tennis rackets, right? We can use this symbol, right? Summation, right? Where X runs from 1 through 5. X is tennis racket, right? PX times QX, right? And then it's not just 10. You have also, because it's a sporting goods store, hunting rifle. I don't know if they sell hunting rifle in sport goods store. It must be, firearms. So gun. I don't like, unbridled, I'm not against gun ownership, but controlled. You have to pass the basic test. It's just like, you cannot be on the road without the license. I mean, if you don't have license, don't be on the road. You shouldn't drive the car, right? And if you don't have any insurance, you shouldn't drive the car. You don't have the car registered, you shouldn't drive the car. Simple and straightforward. So if you don't have gun license, right, you shouldn't own a gun. If you don't have insurance, shouldn't own a gun. Your gun is not registered, you shouldn't own a gun. Right? Simple as that. And if you don't practice safe, I served in the military. I have plenty of experience with firearms. That was, when I was in 20s. So it was, decades ago, 4 decades ago. But I'm against gun. Only, authorized, like military, only police. Otherwise, as a, let's say you live in a very remote area, so you are, you are not directly, benefiting from any law enforcement. There's no police nearby. You call the police. It takes 1 hour, 30 minutes, for the police to arrive. Then you should own a gun, but then must be licensed, right? And if you are a kind of person that doesn't even pass that very basic license test, then you don't deserve to own a gun. I mean, you don't qualify to own a gun in the first place, right? But then, just we escapaded, took a digress a little, because was talking about sporting goods store. So in the sporting goods store, you may sell something else, which is, which could be uh, like golf clubs or basketball. I mean, if you have, so then the golf club will be Y. Let's call it Y, and you can do this for Y as well, right? You can do this for Y as well, right? There are, let's say, 6 of them. 6 brands, 6 models. P. In other words, PY, QI, QY. So what else can do? What else sums up revenue better? I mean, the mathematical definition sums up the best. The definition, the best. It's infallible, it's indisputable, no fuzziness, no cloudy, fuzzy, fogginess in definition. Like verbal definition. Verbal definition turns to be always, foggy and fuzzy and cloudy, right? But there's no cloudiness here, right? There's no fogginess here, and nobody can argue with this definition. So that's revenue, right? And then I'm not gonna passive income. I'm not gonna define it further because it's verbally it simply can be defined verbally because it's the investment income, in other words. And the investment income is just one example. It could be interest payment if you have bonds. It can be dividends if you have stocks, right? Now, then expenses. So primary source of expense is direct expense, direct cost, and indirect cost. And I told you direct cost means it's directly related to production activity. And if it is directly related to production activity, what does that mean? This is the cost of inputs of production. Cost of what are the inputs of production? It's also called factors of production. Yeah. Go ahead. Who was that?
Sorry, I was.
Sorry, I was what? I don't know if it is. I think it's the connection because I could hear I was, and then the after that, the rest of the sentence is lost. So, can you repeat that? I didn't hear the rest of the sentence. Okay, so anybody? What are the inputs of production?
Land, labor, and capital.
Yes. It's called inputs of production or factors of production. Who is this?
DeAndre.
Okay, so I'll give you 0.5. Yeah, in economics, if you have taken economics, you've heard this over and over. Land, labor, and capital. But actually, I would say capital, labor, and natural resources. Right? Why? What does land mean there? What does land?
Natural resource. Yeah.
Natural resource, because in the 18th century, even until 18th century, land basically it was agrarian economy. Agrarian meaning most of the outputs came from the land, so mostly agriculture, and then some mining. So in agrarian economy, land was basically the resource. But in the 20th century and 21st century, land means natural resource because from the land comes not only agricultural produce but minerals, the resources, petroleum, and the resources that are basically being used as a raw material for production. Capital means production equipment, plant and equipment. Labor, human labor. So basically, these three elements are called factors of production or inputs of production. And so direct cost means what's the cost of these inputs in production, right? Which is called, in microeconomics, variable cost. Variable cost. Why is it called variable cost? Oh, do they vary? No, what that means is the cost, this direct cost varies with quantity. In other words, the more you produce, the more quantity you produce, the total direct cost will go up. The less you produce, this will go down. It hence called variable cost. Hence, that's why a variable cost. Okay. Indirect cost, it doesn't. That means it doesn't change with output level or production level, right? It doesn't change with production level. So that's also called fixed cost. Fixed cost in microeconomics because it doesn't change with the output level. Now, we have to stop here because that's all the time we have. So any question, I can, we have about 3 minutes, so I can answer a quick question if the question is, brief. But any questions so far? All right. If there are no questions, then I bid you a good night, good evening. I bid you farewell. So have a great evening, and I will see you guys tomorrow. But one more thing, there is a ROI practice and this quiz number 2. I mean, the diagnostic test number 2. Everyone got that message, right? Isn't it right? Don't forget, you got that message because and it's gonna be due when tomorrow, I believe. Yeah, tomorrow. It actually started today, so don't forget that. Okay. And this one is all just multiple choice. Okay. And I gave you 180 minutes, so that means there are a lot of problems. Okay, a lot of problems. I think 50 problems or something like that. So good luck with that, and have a great evening. See you, and see you guys tomorrow. Okay. All righty.
Professor?
Yeah.
My,
Yes.
My internet just died. You made a announcement about a quiz, sir?
Yeah. The email went out. And there is this message in the this posted in the announcement. So please take a look. The email went out already on yesterday.
Okay, thank
Okay.
you.
All right, you're welcome. All righty, so I'll stop recording.